As we dive into the markets, now just one full week into January, I do want to bring in Thomas Hayes. He's a chair and managing member at Greyhill Capital. Thomas, great to have you on the show.
Great to be here, Kristen.
And as we start this new year, so much focus as to what is in store for stocks. We've seen some choppiness. The S&P just about 3%, though, from its record high. What are you watching?
Yeah, I think this year is going to be a year of slightly more subdued returns and a rotation. So it's not going to be as easy as parking the money in the indices and watching the Mag 7 take you to the promised land. I think what you're seeing is the deceleration in the earnings growth of the Magnificent Seven. So they had 33% earnings growth in 2024. That's going to decelerate down to 21% in 2025. However, you're paying 33 times earnings for it, so you haven't seen any derating in the Mag 7. And if you contrast that to small caps, their earnings growth is going from 8% in 2024 to 21% in 2025, and you only pay 16 times. So half the multiple for the same earnings growth. I think we're going to see a lot of fits and starts as the market starts to recognize where the value is.
What does that mean for the rest of the market, knowing that the Mag 7 is expensive?
Yeah, I think you're going to see huge opportunities under the surface in the unmagnificent 493. Some of the areas that got hit exceptionally hard in December, we did see the broadening start in earnest in July of last year, and it really hummed along until November. And then there was this abrupt interruption as yields blew out, as fears around the Fed in December. We saw the exact same thing in Trump 1.0. Right after he got elected, the dollar rallied, yields rallied between the election and the inauguration. After the inauguration, all of that cooled down.
And because we're talking about yields and the economy, I do want to get your take, Thomas, on the ADP print that we saw today. Because yields have been such a topic of conversation in terms of the direction of this market, 122,000, a little bit less than what was actually expected by economists. What might this mean for that non-farm payrolls report on Friday?
Yeah, we keep toggling between bad news is good news is good news. I think this is a situation, given what yields have done, we do want to see a little bit cooler labor market to keep the Fed possibly in the game, number one, and to put a cap on yields. Yields have really blown out a little bit since the election, just like we saw in 2016. I think a cooler report, if the ADP is any indicator of the non-farm payrolls report on Friday, that's going to be a very good thing for the market. Yields will start to calm down and compress, and the Fed stays in the game, and equities will like that.
International has been out of favor for a long time. Does 2025 change that?
I think it's in line with the theme of what I'm talking about. Price is what you pay, value is what you get. You're going to have over 13% earnings growth in international. It's trading at 15.5 times earnings. In the U.S., you're going to get 14% earnings growth, and it's trading at 22, 23 times. So the thing that people forget, because we're all creatures of habit, recency bias, right? Since 1927, value has outperformed growth by 4.4% per year, okay? Only in the zero interest rate environment since 2010 have you seen growth dramatically outperform value. So unless you believe we're going back to zero interest rates, you want to have some lower price value in your portfolio. You don't have to shift the boat all the way right away, but start to ease into where there's value and opportunity and still growth in earnings power.
Particular stocks then, Thomas, that are on your radar?
Yeah, well, I'm known around these parts as Turnaround Tom because I like buying stocks that are down a lot, but have an opportunity to turn around. One is Advance Auto Parts. They're an auto retailer. They got absolutely decimated. They overexpanded. They brought in a new CEO, Shane O'Kelly. He came from HD Supply, was a $7 billion business. So what has he done? He's taken solvency risk off the table. He sold the Westpac Canada business, $1.5 billion, paid down debt. He's closing all the non-performing stores in the West Coast that are very spread out, so they weren't getting economies of scale. 10% of the stores. He's expanding in those regions where they're number one or number two, consolidating the distribution centers. They are targeting $630 million of operating income by 2027. The last two times they traded at that level of operating income, it was $180 to $220 stock. It's trading at $45 today. So this thing can really grow over the next couple of years under the right leadership.
I want to talk about small caps as well. We've seen optimism return, certainly with certainty following the election. Small caps have lagged behind those magnificent 7 stocks as well.
Yep.
We talk about growth, we talk about value. How do small caps fit in?
Well, I think small caps is where you're seeing the most value. One of the names that we love is a company called Cooper Standard. Again, 2 auto turnarounds for you. You know, people are sleeping listening to this, but this is where the opportunity is going to be in 2025, 2026. This company's down 90%. It had a refinancing risk. They got it refinanced in 2022. They do the sealing systems around the doors, boring stuff, fluid transfer systems. The operating leverage in this business is huge. All this is a play on volumes increasing. We did 16.8 million annualized SAR in December. If you remember, those auto numbers surprised everyone. The volumes are coming back up. The last time they did 17 million, the business earned $7. It was a $140 stock. Stock's trading at $14. They've taken $400 million of costs out of the business. So this thing, we believe, over the next 2 years could earn $7 to $10 a share, which means, you know, you apply a 10 times multiple, it's really going to move.
All right, Thomas Hayes, in from the West Coast.
Yeah.
Thomas, always a pleasure. He's a chair and managing member at Great Hill Capital. Thank you.
Thanks for having me.